All right. Okay, so we can get started now. Thank you, Tanisha, for helping me out with this training today. Today we're going to talk all about the pros of, it's really not any cons, but the pros of being able to get life insurance over your home so that the debt of your home is covered for your beneficiaries. So Tanisha is my broker with the company, and she's going to be going through a presentation sharing with you the types of policies that you can structure to cover these items, your debts, your home, anything that you need to cover for your beneficiaries. So
Awesome. Well, thank you so much, Naifi, for introducing me. I appreciate it. My name is Tanisha Williams. I'm a marketing director and broker with PHP Agency. I work with these fabulous ladies in building their businesses through their real estate as well as now life insurance. So I'm just going to talk a little bit about what that looks like whenever you're meeting with maybe future clients or current clients, how you can structure their home to make sure that they're covered in many different ways, not just their home, but that's kind of what we'll focus on. So I'll go ahead and share my screen if I could get sharing capabilities, and we'll talk a little bit about what that looks like. I think one thing a lot of people miss about insurance, about how profitable it is. It is actually one of the most profitable industries in the world for several reasons. One, because if you think about it, in real estate, when you're, getting your client ready for the home is the tangible item that you will be using, and there's money at the beginning or the end of the transaction. But if we're thinking about insurance, insurance has money involved. And that actually is the tangible item. So it's money at the beginning, middle, and end of the transaction, automatically making it more profitable. So I'm going to go ahead and share my screen, and we'll talk a little bit about different policies and how we use the power of life insurance to protect clients. So one of the things I'm going to talk about is why insurance. We talked a little bit about that, but showing you the power of insurance, the many different ways that you can use this asset to be able to show your client not just protecting their home, but giving them ways to escape taxes, as well as also showing them tax-free ways to access cash value. We'll talk about the specific policies for home protection and how you can even structure these policies to protect future homeowners. And once again, if you're interested in looking about getting a license, how could that work as well with the additional stream of income? So once again, we were talking about why insurance. As you can see here, I pulled up from the research department on Statistica. This was at April of this year. It's showing that life insurance and annuities are the second most profitable industry in the world. And we're talking about $242 billion industry just this year. So that goes to show you that life insurance and annuities can be used to be able to gain wealth as well as transfer wealth. So when you're sitting with clients and they're looking for ways to be able to grow money or have other avenues to protect the current money that they have, you can show them how these policies can do that as well. So, all your clients need to protect their homes. I know a lot of, companies offer, mortgage protection through other companies, but you can show them how a life insurance policy can protect their homes, and they might actually be able to do it a little bit cheaper than homeowners insurance. But you can protect their life, their health, and retirement through all of the products that we have here, and be that one-stop shop for your potential clients. So specifically, what type of policies can be used for mortgage protection? Actually, any of them can. Why is that possible? Because if you use an insurance policy, there is a death benefit attached, meaning that if your client passes away, whether it's a term policy for a temporary time or even a whole life policy that will protect them for the rest of their life, they can use that policy to protect them with a death benefit. But there's also particular type of policies that will allow your client to be able to grow cash value, meaning access to actual funds that they can use for mortgage protection, for a down payment, for specific things in the home buying process. And we're actually going to build these out so you could see the power of what that looks like. So for example, all of our policies either are term, which is temporary, or whole life, that will protect them till the day they die. And all of these can be structured for mortgage protection. So each policy can be built out and you can tailor it to your client's budget so that it can be used for mortgage protection. Meaning that, for example, if you have a customer who says, hey, I actually don't have a life insurance policy, but I want to use this specifically for home protection. I'm going to use this term policy to cover me for 30 years because that's how long my mortgage is. And I'm going to make sure that if anything happens to me, that death benefit will go strictly to pay off my home. So the spouse won't be taking that burden on to be able to have to pay that mortgage if that income is no longer there. So we'll actually use a policy and show you how that can be done through a term policy, as well as whole life. So whole life policy means that you could protect your client till the day they pass away. And I'm talking about not till 80 or 90, but I'm talking about to 120 years old. And each of these policies with the cash value that grows inside that whole life, they can tap into that for any time. So let's say they need to do home improvements for their home once they buy the home. You can actually get them covered and get them in a home, but actually structure this policy to be able to use for future renovations for a policy. If you have a client who wants to use a starter fixer upper, meaning that that's the type of property they want to buy, you can actually structure this policy to say, hey, based on a certain amount of money that you're putting inside the policy, within 3, 5, or 10 years, we can use this to be able to use that money to be able to fix that home up, fixer upper, and actually flip it in the future as well. So the first one I want to talk about is a term type of policy called a return of premium policy. What does that mean? Most people in insurance who have an insurance policy, they're underaware that a policy can actually give you all the money back in the end. What does that mean, Tanisha? That means that most of your clients that are paying term policies, they think that a term policy is just coverage for right now. And when that policy expires, they actually lose all the money. But the return of premium can actually be structured to pay out all of the money back at the end. So for example, if you have a customer who says, hey, my home mortgage is $300,000, but I want to get the return of premium to where that at the end, it will actually pay me back all of that money. And I can use that money to be able to pay off my home if anything happens to me within that 30 years. So that's what the return of premium does. They actually can even take that and use it to a paid up whole life policy if they didn't want to use it for that reason. But most of our clients, they actually want to use this particular one as that mortgage protection. They can take the death benefit, for example, let's say it's $300,000, and they can use that amount and actually receive it tax-free. So for example, if you have a spouse that passes away in 30 years and that mortgage still needs to be paid off, that beneficiary is going to receive all that money tax-free. They don't have to worry about paying Uncle Sam $1 because all life insurance policies will actually be able to get that and receive by the beneficiary tax-free. So all that means is, example, for your client, if they pass away, they would actually be able to save money versus maybe having to take out a secondary loan or use another stream of income to be able to pay off that mortgage. Now they can use the death benefit to do that tax-free without paying any taxes. And then a whole life policy, once again, that's the policy that's going to protect your client till the day they die. Our policies within our organization protect people to 120 years old. Now, if they live past 120, I can't do anything about that, but I definitely could do something till 120. And the whole life policies that we structure is called an index universal life policy. Now, universal life is just a fancy word that means client is protected until the day they pass away. Index means that when it comes to the growth within that product, you're getting most of the money back. Now, there's many different type of universal life policies, but actually it's also allowing your client to have access to 2 banks of money. What does that mean? That means that with a traditional term, there's a death benefit, but in this whole life policy, they have a death benefit and cash value. So when they pass away, they're leaving their family a death benefit and the cash, both sums of money when they pass away. So we'll actually see, once again, accessing this tax-free, which means that they have the ability to grow money inside the policy, and they actually can become their own bank. And your client can use this for any reason. So if they come to you, let's say a 20-year-old says, well, I might not be in a financial position to be able to have money for a down payment, and there isn't maybe any programs that work for them to assist with that down payment. You can say, wait, I might have another solution for you. Let me show you how to structure a whole life policy that grows cash value to where that you can access that money tax free, borrowing it from yourself, and you could pay yourself back instead of a bank, meaning that they can use that whole life policy to access that money tax free and use it for that future down payment. So you actually can get clientele now at a young age to structure out these whole life policies for them. So in 5 to 10 years, when they're ready to buy their home, you have their policy to be able to get that tax value out as well as put them in the home. So you can help even future clients get into a home by building out these policies for that. So what I want to do is I want to go and show you what it looks like if your customer says, hey, I'm interested in a 30-year term policy, which we call a return of premium. I'm actually on one of the biggest insurance companies in the world, Mutual of Omaha. So Mutual of Omaha is a $7 trillion business. A lot of people know them. They've been in business for a very long time. They have a term policy that's called a 30-year return of premium. So I just use this as an example. I have a customer in Delaware. She is 20 years of age and she's a female and she doesn't smoke. And she says, Tanisha, my mortgage is $300,000. So I'm going to structure this 30-year return of premium for her to be able to allow her at the end, when she's still alive, to get that money back. So I'm going to show you what that looks like. So we build it out with a death benefit attached of $300,000. So what does that mean? That means if the customer passes away in 30 years, their family is going to receive a death benefit of $300,000. But what would it look like if she's still alive? Let me show you. So the customer will actually pay $100 a month. So think about this. If you have a customer who says, wow, I'm looking for other alternatives for mortgage protection, show them this return of premium. Because she's 20 years old, she can afford $105 a month. But what it will allow her to do is receive $135,000 back inside our policy. So think about it. $135,000 tax-free that your client would get if she was still alive in 30 years. Think about what that could do for a 20-year-old at 50 if she wants to buy her first home. Or even if she uses other means to buy that home at 50 years old, now she has $135,000. She could pay off that mortgage, but she could also get a rental property. She could go buy a duplex, but she has $135,000 to be able to do that now through the return of premium policy. So I guarantee you in insurance, like think about it. It's the same concept that if Geico says, I'm going to give you back 30 years of premium if you're still alive in 30 years. I'm sure that would make us all happy. This is the same concept in insurance. So you have the ability to take your clients not only to protect their home, but it also can give you an additional source of income because you already have the clientele through your home buying process. So this is what the return of premium looks like. Now I'm going to go to National Life Group, which is another insurance company. They've been around 175 years, and build out the Index Universal Life Policy. Now, the reason I love this policy is because I have it for myself, because you actually can build this out for as old of a person as 75 and as young as a person as 2 weeks old. So if you have a client who loves buying houses, let's say they own multiple properties and they have children, and they would hope to be able to show their children the same thing as well. You can tell them, hey, let's start protecting your 2-week-old now with an Index Universal Life Policy with $25 a month. So when your child actually becomes of age, they would actually have their own cash value to start buying their first home or buying an Airbnb or whatever they want to use that cash value for. You can start it as little as 2 weeks old to also help them become a homeowner and also have them children as a repeat customer when they are of age to buy a home. So I'm going to use an example for one of my daughters. She lives in Washington. It's called a Flex Life Index Universal Life Policy. And she's 24 years old. So I'm going to use her as an example. Tori, I'm going to put in her information. Doesn't matter what I put there. And her date of birth is 1/2/1996. Okay. So she's 27 and she doesn't smoke tobacco. So based on this type of policy, we're going to make sure that your customer gets max cash value, and we're going to change this up until age 65, which is normally retirement year. And she's going to pay into it monthly. So we're going to tell the policy that she's going to structure this based on her age. So normally when we put someone in this type of policy, we tell them as a rule of thumb, whatever your age is, put a 0 behind it to see the full power of the product. So she's 27, so I'm going to say she's putting in $270 a month. So as you can see, this policy is going to be used with different type of insurance products, which is tied to the SP 500. So also, if your client is looking for strategies to be able to grow money, they say, hey, I'm actually doing a lot of things in IRAs or my 401k or other different vehicles, but if it's tied to the stock market, your client's losing money. So just curious, are you ever invested in insurance products? Because it guarantees that you can grow your money without ever having a loss. Yes, insurance does that. So these are the type of vehicles that we use to be able to structure this product. So as you can see, we use SP 500, we use Credit Suites, we use US Paysetter, because these are actual stocks that are not vested in companies. They're vested in compound and municipal bonds, which are those A+ bonds that your Tesla, Amazon, Apple vest their money in. And when they get growth, they're giving you back most of that growth within this policy. So you could see the rate is guaranteed, and it's something that your client can actually use as tangible means to actually grow money. It's a guaranteed structure. So I'm going to go ahead and go to Quick View. And this is telling multiple things. So your client is going to start off with a death benefit of $233,000. What does that mean? That means if they pass away today or tomorrow, they're covered with $233,000 to the beneficiary. So that also, death benefit alone could be used to pay off a mortgage. But this policy grows cash value, unlike the term policy. So she's starting off in 1 year. She's age 27. She's putting in $3,240 a year. That's what the plan premium is. The accumulated value is that cash value of compound interest. So in her first year, she's already gotten most of the money back she's vested in compound interest. Amazing, I know. Her surrender value means what she has access to. So this is meant to be a long-term strategy, which means that your client won't have access to this, well, all of the growth within the first 10 years, but they have access to 40 to 80%. So what does that mean? So my daughter's 27 years old. She already has a home. In 10 years, she's going to take the cash value inside this policy and get a rental property. What does that look like? So as you can see at year 10, she's already grown $31,000 of tax-free cash money. So what is she going to do with that money? She has several options. She's going to borrow that money from herself. The amazing thing that your client needs to see about this policy when it comes to mortgage protection is that if she borrows, let's say $25,000 for her down payment, it's still going to grow like she never borrowed the money. So it's still going to tell the account it has $31,000 in there, even if she accesses it. So she has the ability to pay herself back over time, or if she doesn't, the death benefit is the cushion. So if she borrows $25,000 and don't want to pay it back, it just lowers the death benefit by that much with the interest. So your client has a way of accessing that tax-free money and using it for whatever they want. They can structure it to be able to use it for another down payment on a home. They can use it to be able to funnel Airbnb. They can use it for, renovations on another property. So this is allowing your customer to not just be a customer one time, but to be a customer multiple times through these policies. So the beauty of what this looks like, even for your customer, if they say, you know what, I'm good in my home, I'm actually just looking for other strategies to grow money. You also can funnel this to actually protect your customers' retirement. How is that? So this policy protects our client until 120 years old. Now, I want you to look at the growth over time. Let's just say based on the $270, my daughter at 65 says she's ready to retire. This is giving her $408,000 of tax-free cash money. Her death benefit is $614,000. So what does that mean for your client? They can use that 408,000 however they want to. They can pull it all out in one lump sum tax free. So that means that at 65, your client could go buy another property free and clear because they have the cash value if they want to. They also can use it and give them a monthly stream of income. So they could say at 65, I no longer want to work. Can I take that 400 grand and issue it out lump sum? Absolutely. So your clients can even use this to pay them out for retirement as a monthly stream of income till they pass away. So if your client passes away at 65, you would know that they would have cash value to cover that mortgage, 408,000, but the family would still receive the death benefit and the cash. So you would be leaving the family almost $614,000 when they pass away. This is how we pass down generational wealth. This is how we use the power of insurance to make sure that our customers stay customers for the rest of their life. Now think about it. I'm also going to show this what this looks like for, let's say, a baby, because I think that your clients need to see, okay, I'm raising, you have your family, you protect them in a home, but what does it look like for their children? You want to keep their children to be able to also have them in a home in the future, as well as protect them as well. So I'm just going to change the date on this. Let's say if we have a child that we're protecting at 1 year old. Let's say we'll build it out that way. So I know I need to scripture that and change that. Okay. So now we're talking about a 2-year-old baby. What does that look like? So let's just say I want to put in $50 a month for my child to start growing money inside this policy, because I want my child to be a homeowner one day, and you want those clients' children to be a homeowner one day. Let's see what that looks like if we structure that payment with just $50 a month. And this is for 2 weeks old. You can put them in a policy. Now, the beauty with a child is, let's say that you don't want your children to work to 65. Let's say I want to work my child to work till 65, and after that, they don't have to work. With a child's policy, you can actually structure it to where that you no longer would have to put money inside the policy, and it would still continue to grow, which means that they vest 100% of what it needs to do for the money to still grow without any additional payments. Beauty of insurance. So let me go ahead and go to quick view. So that 2-year-old is going to start off with a death benefit of $154,000. So that means that if anything happens to this child, you as the beneficiary can make sure that your client receives that money, to where that if your client maybe needed to stop working to grieve their child passing away, they would have $150,000 to do so, to be able to be at home, be a present parent, to grieve their child's death properly. That's something you also can provide for them. Once again, we're starting off at year one. The baby's 2 years old. They're putting in $600 a month. Now, this is going to make sure that your client, let's say at 18, your client needs to buy their kids their first car. You're going to make sure that they have $10,000 to be able to do that at the age of 18. What 18-year-old wouldn't love $9,000 to be able to use for college expenses or buying their first car? You can do that within this policy. Now, let's say at 30, they're ready to buy their first home. They have $27,000 of tax-free cash money to do so, to have a down payment for their home. So think about the legacy in this. You put their parents in a home. You protect their children. And when the children grow up, you actually put them in a home as well. Because think about it. What would be the best referral source is your current client. So you would be able to protect them and their children as well. Now, if this child did not use that money at the age of 30 to be able to have their own home, let's say they're using it just for retirement. At retirement, at $50 a month, your child at 65 is going to have almost $300,000 of tax-free cash money. $50 a month. Think about that for a second. Think of how your clients would benefit this if they saw this for their children. They wouldn't have to put the money in a savings. They could structure it inside this policy and have them to have tax-free cash money when they retire. But as you can see now, the policy no longer is funded, and this money continues to grow up until the day they pass away or 120 years old. if your client lives that long. So I'm talking about giving your customers and your potential clients generational wealth. You're putting them in a home, building that asset, but they also can even use the equity inside of their home, pull it out, and structure it in there as well. Why? Because when they access money here, they do it tax free. They never have to worry about paying Uncle Sam $1. So if your customer comes to you and says, hey, I have about $100,000 of equity in my home, but I want to make that money work for me. What could I do? I'm going to show you how to funnel it through an index universal life policy and grow money that they can build very fast and tax-free. So there's unlimited ways that you can use these products to be able to structure your clients to get into a home. Even clients that may not qualify for a home yet, you can help them build up a down payment for a home to have them as a future client as well. Awesome. Then the last thing I want to talk about is, what does it look like if you're interested in getting a license? It's pretty simple. So we work for a company called PHP Agency, and that stands for People Helping People. And what we are is insurance brokers. So once again, it's the same concept in real estate, meaning that if you wanted to be able to work with a broker and give your clients access to multiple homes in the MLS, same thing with insurance. You can do that and actually work with multiple carriers to make sure that your customer gets the best bang for their buck. So you can shop around for them like Amazon to make sure that you could cover them with life, health, and retirement options. So the reason that Ms. Knifey and Ms. Shirley joined this organization is that they are building themselves to be a one-stop shop for their clients. They do multiple things in the home buying process as well as credit repair, and they've also added insurance to be able to service their clients. So a lot of people come into this industry and start off as a part-time second income. That's an agent who helps about 2 families a month contribute $250 into a policy. You're looking at an extra $2,400 a month. Personal producers, someone who decides they want to do this full time and help about 4 families a month, you're looking at about $7,200 a month. 3 is a marketing director, which is what I am. That just means I'm a broker and I help other agents make income, get a license, and tap into their market to be able to protect families as well. And then the last one is a national agency. That would be if you would love to open up an office one day where your clients could come sit with you. You can get them into a home and protect their life as well, becoming that one-stop shop, and also help them in an office. We provide all the tools that you need. A lot of people come into the industry and say, wow, how do I go about learning this? How do I get licensed? What does that look like? So we have a system here at PHP that shows you everything. So it's classroom training we do twice a week, and that's for an hour and a half where we show you exactly how to know what customer needs what policy, what type of products, what are the different companies, what does it look like for my clients. We show you in there, as well as having access to a software that allows you to be able to submit policies through an e-app. I see you have your hand raised, Ms. Shirley. I want to make sure I answer your question.
I thank you so much. I just wanted to go back since I had you here. I have a client that I'm currently trying to help, and she asked me if she did a life insurance policy and she used it for mortgage protection. Mm-hmm. Can she put somewhere in that policy that maybe her children can't sell the property? She wants the property to stay in the family. Is that something that the insurance agent handles? Or
So good question. So when it comes to a life insurance policy, when we sit down and do an application, the client actually decides who's the beneficiary. So if they have a living trust in place, that would be the legal option, that it would be a bound set to where that this policy will be used to be paid off my home, and no one can sell that home. As an insurance agent, we don't handle that, but we can definitely point them in a direction of someone who can help them establish a living trust. So the beneficiary would immediately have access to those funds, but the living trust would make sure those funds would actually be used for that mortgage protection. Great question. So
Thank you.
absolutely. So when we're working with clients and we're helping them in this process, we can show them, okay, if they say, hey, I want to make sure this actually is used for that, we can show them, okay, setting up a living trust is to make sure that's actually that money is to pay off their home. And we can help them and direct them with some of the people that we know in the industry that would help them set that up. And then licensing is our second process in the system. We help you get licensed. These ladies got licensed super fast. So it's a process. It takes normally 3 to 14 days to get that license. It's not as hard as the real estate exam. I can tell you that because I took it in the past. You just need a 70% in most states to pass. And then the last one is a field training. That's where I actually help you tap into your market, and we go and build this list from whoever you want to share with what you're doing. It could be people you know, people they know, and social media. So you have us here every step of the way to help you build this market and actually go to maybe past clients and tell them, hey, guess what? I'm now a life insurance agent. I would also love to be able to help you protect your life when it comes to your health and retirement as well. And we show you through the PHP system how we help you do that. So most people come into this industry, especially in real estate, and start on a very part-time basis, a couple hours a week to be able to start building your clientele through insurance. Your state required licensing is $220. $199 gets you set up in our PHP system, and $20 is for that exam material when we sit down and actually show you how to navigate those life insurance classes. And then exam, fingerprinting, and filing is $100 to $300, depending on the state. They just want to make sure that you don't have any felonies, bankruptcies, misdemeanors, or tax liens. It actually doesn't stop you. It just slows down the process. The only thing that they really flag is money laundering. But I know with real estate, your license covers you as well, so you should be good to go. So this is what it looks like if you decide, hey, I would be interested in getting a license and getting your clients protected in that avenue. So the last thing I want to talk about is, what is your number? So if you say, hey, I'm ready to get a license and I want to make an additional stream of income part-time, you would drop a number 1 in the chat. If you also know, I want to learn more about the policies for myself or someone I know, I might not be interested in getting a license, but I saw the value in protecting my life and leaving my children a legacy, I want to talk about the products for myself, or even both. So I know this is also going to go out on replay. So if anybody watches the video, and of course you can't drop something in the chat, please reach out to Knifey directly, and she can definitely help on all of those steps. So just moving forward, guys, real estate does an up and down. We know that. That's the market, right? But what would it look like to make sure that you could still have those clients while real estate is doing the up and down? You can make sure that those clients become repeat customers through your life insurance license. So Knifey, I'll turn it back to you. Thank you so much for your time. It was a blast.
Thank you, Tanisha, for sharing all of that information. Tanisha has been giving me so much information since I started the industry about 2 months ago. We're now writing policies for multiple of my clients as well as for myself. I'll be creating policies for myself and for my daughter only because I'm clear on the purpose of these policies. So I'm grateful for being able to get this knowledge, because we don't learn this in school at all. We don't even learn how to write checks in school. So this is some information that we need to get out and to educate people on. So I'm going to be sharing this information with everyone that registered. And then also it's going to be over on YouTube. So I'm going to send out an email and also post it in my group. But feel free, as you see this information, to share it with somebody that needs it, because honestly, I love to say this, there's a purpose in these policies. So thank you, Tanisha, for joining us today.
Thank you so much.
You're welcome.
Thank you,
Shirley.
You're welcome. Thank you, ladies.
All right.